Hello and welcome to this fourth episode of Your Next Trade. Today we're going to be talking about 75% emerging markets. So please read the disclaimer before doing anything. So why are we talking about 75% emerging markets? Because these days it feels like the dollar is so strong that anything that is outside the US dollar, which is making 75% of the world GDP, if you exclude the 25% of the US GDP, that we are all emerging markets. So not only in the UK, I live in the UK, but that's true for most of the currencies against the US dollar for this year. So let's start as usual with talking about the week 2 data set performances. With the global picture is more or less the same as the week before, where all the equity markets, stocks, went down roughly almost 5%, except the Brazilian market. But the big picture really as well is this one that is really important, which is the King dollar. So the dollar, so now I've put all the currencies versus the US dollar to make it a bit easier. So here we get the DXY, which is the dollar index. And you can see as well that most of the currencies were down between 3 to 4%, 5% versus the US dollar. Only the Japanese yen is flat on the week, but that is due to a big intervention for the Bank of Japan on Thursday morning after their meeting. And the overall picture for crypto is the same, down, WTI down, commodities down, natural gas down. So overall, risk off across asset classes. The only one standing is the US dollar, which is making really market struggling. Why is the US dollar so strong? We're going to be looking at it before, but that's for the week-to-date industries performances. And if you look at last week or 3 weeks ago, the picture was almost the same. So on the one end, on the right end of the spectrum, we get the US dollar that is up on the week, and the rest of the industries are all negative. What is interesting is actually yesterday we had a huge sell-off in the oil. WTI went under 80. Most of the oil stocks were down between 7 to 15%. So we had some red flags with the weakening of the WTI. We had some charts like Halliburton and some others that were challenging their trends, and we had the big gaps on the open yesterday. But overall, the picture is pretty nasty. And the US dollar, why is it so strong? Because the picture is the same as before. Yields are going up, bonds are selling off. So if you look at the US 10-year, on the week, it's up 25 bips, which is quite something. We had a big move since the start of August. So you see this move where we are talking 1% more, 100 bips more from the start of August to as of yesterday. So that's really a relentless move. And it's true as well for in the UK, where the gilts were absolutely hammered due to the UK budget. It's true as well for the German Bund, up 27 bips. The only two places standing are still the Japanese yen and China, where actually both currencies as well are weakening due to differential in rates. So that gives you an overall picture where actually something that we discussed a couple of weeks ago, the inversion of the yield curve is still ongoing. So there were some hopes 2 weeks ago that the Fed will pivoting, that we will be going into at least a steepening of the yield curve and potentially going positive. That is not happening. So the market is more and more pricing US recession coming into next year. And overall, that is the same as last week. The Fed is more and more hawkish. Here we are looking at the euro dollar. So now the market is pricing a terminal rate that you have here, which is the max rate of this cycle from the Fed between 4.5 and 4.75%. Okay, so that's a 4.5% that you have here. And from 1 week to another, we move by roughly 25 bips. So that is quite something. So market is expecting now the Fed to be more hawkish by 25 bips. That really that is coming and affecting the overall equity market, where the VIX week to date went from 26% to 30%, which is actually, if you look at Wednesday, the market didn't overreact in terms of VIX, because a lot, as we discussed last week, there is a lot of options that are short dated and driven the market, whereas the VIX is on the 1 month. But as the most important thing that you can see here is now there is a flattening of the VIX future term structure, and we could even see a real inversion. I mean, it started to invert. That means that when you start to see the VIX going like this, there is really starting to have a lot of stress in the market. It's not. We are not yet in that extreme stress scenario. I've been reading on Twitter people saying, this is it. We don't see very often the market bottoming on Fridays. And if you look at the risk and the stress that you have in FX, the stress that you have in the bond market, actually stocks have been doing pretty well. And if you take the assumption that very often the equity market should be and is following the bond market, you might expect some more stress. So I would like to jump into the technical analysis, if I may. So that's my. Let me just open briefly. Where are we? Up. So I'm going to be opening my trading view. So trading view, as always, we're going to be starting with the S&P futures. So S&P futures, the picture was pretty clear from last week. We said that it went below this trend. Now we are challenging the lows that we saw at the expiration, which was in June. So in June, we made the lows on the Friday of the expiries, and we managed to bounce. And actually, we had a massive bounce of 20%. Since the expiry in August, we have been trending down. And if you look at the other charts, Nasdaq, Russell, the chart are more or less the same. So we are going to be testing. We are close of testing the new lows. And if you look actually in Europe, we have been breaking lower. So if you look at the DAX, if you look at the Stocks 50, if you look at the Stock 600, something that I flagged yesterday morning before the breakdown, we have been breaking lower those trends. So the picture in Europe doesn't look really pretty. As the title of this Your Next Trade is 75% emerging market, it's really important not only to be looking at developed market that feels more and more like emerging market, but looking as well at core emerging market in China and others. So hopefully, maybe China is going to reopen, but the picture is still very gloomy for emerging market for two reasons. The first fact is when the dollar, US dollar, is so strong, that is not helping emerging market. And secondly, as they have been printing a lot of their debt in US dollar, you get the double killer, which is you print in dollar and your currency is weakening versus the dollar, and on top of that, yields are going up. So emerging market, not only as developed market like UK, Europe, and Japan, the real emerging markets are suffering. As I mentioned, XLE, which stands for the energy sector, so which was holding pretty well so far. You have this big gap here going into and below the 200 moving average. So the picture is pretty ugly. And if you go into the CL1, that's something that we flagged before, and we say you need to be extremely careful because the 82, 83 level, if we break this level, we're going straight into the 73, 74. Why? If you look at volume that was done in the past, there has been a lot of volume profile down around the 73, 74, 75 on the WTI. So that is the overall picture, which is another way of telling ourselves that a market is now really pricing a global recession. And this global recession is strengthening. If we look at the euro dollar, looking at the currency, that is the same picture. This is still the trend, so we might be testing these low trends. this lower part of the trend. As long as we are in this downtrend, there is no change in the global picture. Japanese yen, so we get the intervention, which makes the chart a bit better, meaning that above 145, I think people will be careful to go along the dollar against the Japanese yen. So that is it like the limit that the Bank of Japan is accepting? Actually, this is potentially the first one. If you look at the dollar, renminbi, Chinese yuan, it is still weakening. So in terms of triggers, in terms of catalysts, something that we flagged. So around the 15th of October, the Politburo in China is meeting. There was some noise yesterday in the market that actually the leaders of China could be changed. Obviously, that will be a huge catalyst for the market. Don't put like too much emphasis into that. But if there are talks, that means really the market is looking for drivers. Quickly looking at single name stocks, I think what is important is to, in this market, is looking at support, resistance, trend, and we go from one place to another. And when I say one place to another, is we go from one extreme to another. If you look at the S&P, over 2 weeks, we went from the top of the trend to the bottom of the trend. And that's true for names like FedEx, from Adobe, where we move by 20%. So what we try to identify these days when the market is so weak is leaders versus laggards, as always. So if you look at the S&P for this week, and I just made a bit of work, is trying to find, which are those stocks. So out of 2,000 stocks of my universe in the US, 1/3 of them outperformed the S&P and 2/3 underperformed. So 33%, 67% roughly. And what is interesting is always to see what are the stocks that are behaving nicely when the market is in a shitstorm. So if you look at Home Depot, actually yesterday did okay, finished flat. So if you look at Home Depot, so you have this support, so that could tell you where is your stop. You should be looking at Home Depot versus the S&P. This is the confirmation. This is not a strong confirmation, but literally this is the same here with Eli Lilly, the trend doing pretty well if you look at the long-term picture. So in terms of catalyst, this is about looking at how the stocks have been behaving versus the S&P versus the Nasdaq. And so it's called relative strength, and you should be comparing not only the stocks, industries, and sectors. So that's something we do a lot during mentoring. This is something that I push a lot in the 4x4. It's about identifying those winners and losers. So if we go back into Excel now, if you look about this week, the picture is more or less the same, which is all about the central banks, all about the US dollar being so strong. So the US dollar is the king for the time being. What was interesting is something that we discussed last Saturday is the market so far was behaving pretty well on the day of the FOMC. And actually, as always in 2022, the market is trying to hurt you as much as possible. So when you start to see on Twitter tons and tons of people telling you, oh, we have been doing well on the FOMC, you know what's going to happen on the day the market is done. So markets really struggle from the moment Powell started his conference. He was pretty much hawkish, pretty much, and that's an understatement, very much hawkish, and that means that we should not be fighting the Fed, and it goes absolutely both ways. So when the market was enjoying QE, was enjoying low yields, there was no point fighting the Fed. And here this is the same. As long as there is no change in the story, we are going the same way. Yields, bonds are selling off. Dollar is stronger. Bonds are selling because people need to find some dollar. So if you can't find dollar in the market, what you need to do is you're selling your US Treasury, and this is probably what the Bank of Japan is doing, what the Bank of China is doing. And even if you try to fight it, as the Bank of Japan has been doing from Thursday onwards, it's going to be hard because the trends, the macro trends are very, very strong. So what happens is these days, out of the US, it feels very much, if you look at your currency, that you are emerging market. Why we're going to be saying that is when your yields are going up, this is what happened in the UK. That's what happened in Europe, and your currency is coming down the way it is. It is very much like emerging markets. So it's the same as Turkish lira. When you put your yields higher, expecting for your currency to be stronger, and your currency is weakening, that is not a bad sign. I don't think this is. We should only be blaming UK and some others, and that is an overall phenomenon that we have seen over the last 6 months. What is interesting is the total denial, I'm living in the UK, that we have from politicians that came with a very expensive budget. If you think about it, 2 years ago, they said, we should be careful not spending the money where yields were at zero. And now they're happy to spend tons of money. So it's a big bet. The market doesn't like it. It's too much. And you don't have now, as the UK, the backup of the European Union. Even if you don't like the European Union, you do have like 400 million people, and you do have like a lot of economies which are overall making 15% of the GDP, which is much, much bigger than the UK GDP. So the market is in a phase of challenging everyone, and challenging position, challenging countries, and that's going to be interesting to see how the UK is going to be reacting, the government. So overall, US dollar is very strong. I wanted to put like something that is extremely important. The dollar is very strong and potentially too strong, and that means not only Europe, UK, Japan, but obviously the US are looking at it, and we should be expecting in the next couple of months or more some global interventions one way or another. So just 2 weeks ago, I said that Bank of Japan was close of doing something. Guess what? They did something this week. It's not because I'm a genius. It's just because we are going into the extreme. And as we are going into the extreme for the US dollar, as we are going into the extreme for the weakness of other currencies, that means politicians will have to sit together and try to find a solution. Is it global intervention? That is potentially what's going to happen. We don't have the answer, but that's a catalyst to be looking at, because all the currencies, as you can see, versus the US dollar are doing the same. And you start to see some big panics here. This is the UAK 5 years gilt, where literally the bonds yesterday went into a massive sell-off in the UK. So that it feels a bit like panicky, and central bankers are talking to each other. And if you have some huge pressure, some dislocation somewhere, even if it's only the UK, 2 to 3% of the world GDP, still that's going to be affecting the world. That's going to affect the other part of the system. And if it starts with the UK, then in Europe, that means it's going to have effect as well on the US Treasury and everything. So you can make sure that central bankers and others will be sitting together if the dollar carries on like this. So in terms of catalyst, the picture in here, I put the crown of the US dollar plus the US Treasury, the 10-year. That is, the trend is still the same. You look at those two, which goes hand in hand. As long as the US dollar is so strong, as long as bonds are selling off, and I'm talking the US, everyone is following. Okay, everyone is following, and it's the same as a stocks. So we go with beta. When the bonds in the US are moving by 10 bips, they will be moving by 20 bips in the UK or in Europe, and the only place where they are not moving is in Japan and in China, because it's controlled. But if it's like a dam, if the water is coming and adding at one stage, it might break. So that's true for Japan, that's true for China, so that's true for the Hong Kong dollar. There are places where tensions are building, and it might break. So What are we looking for this week? We're going to be starting with tomorrow with the Italian elections. If you've been trading for more than 2 years, you know that there is always a bit of drama coming back from Europe, and from Italy is one of the place where there is a lot of drama because governments are changing every 2 years. So new government expected. We see what's going to be the rhetoric of these new governments versus Europe. In terms of other catalysts, we get the Chinese PMI on Friday, but really the big part of the story is here, where we get a lot of Fed speakers. Every single day we're going to have the Fed speakers due to the decision and what the Fed has been saying on Wednesday. That's going to be very important to know what most of those guys are going to be saying. So that's the Fed speakers. We're going to have 2 to 3 every single day. By definition, they're going to tell you that they are still hawkish, that inflation needs to come down. We know that even if inflation, the headline number is not great, inflation is actually coming down. Why? Because, a lot of leading indicators are telling you that, and we are talking ISM prices, we are talking freights, we are freight rates, many commodities coming down. So inflation will be coming down. The problem is it's still way above the 2-3% of the Fed or the ECB. So it's going to be taking a bit of time for this for the inflation to come down. So that means, and if you look at the euro dollar that we discussed before, that we should not expect 2023 for central banks to be cutting rates, at least for the timing. So in terms of drivers, a lot of Fed speakers. In terms of flows, important to be looking at end of the month, end of the quarter. If you look at the end of the month, so the rebalancing is more or less, if you get a book 60%, 40% between equities and stocks, you need to be looking at the rebalancing between the performances of the two. Stocks, end of the month favor stocks because stocks are down quite a lot for the month, 6%. If you look at the end of the quarter from June to July, actually it favors a bit the bonds, not that much. So you might see a bit of rebalancing. But overall, for equity traders, we are mostly looking and feeling like we are macro traders because we are looking mostly at FX and we are mostly looking at bonds. And if you look at the volatilities of both the bonds and FX, that is something that we haven't had for quite a very long time. So this is really the place to be looking at and the place to be looking at for the drivers and for the catalysts going forward. So really, earnings are going to be very quiet. We're going to have some macro data, but actually it's all about how the Fed is going to be unwinding and going forward, and what is the bonds and the dollar going to be doing, because we are all second derivatives. All the assets are second derivatives of those two. So that is for the week. I hope it helps. If you got any questions on the 4x4 video series, you can go on duponttrading.com. If you got questions, you can send me email. You can join us for free on the trading community, which is on Discord. We discuss every day. I met some of you this week in London. I'm happy to do questions if you have to. Not if I have to. I'm happy to do them. And subscribe to the channel if you like it. And you can put some comments. That's something that I enjoy doing. So again, all about the macro, all about the dollar, all about the bonds. This is the king dollar. It feels very much like we are all emerging markets, especially in the UK. But hopefully everything is going to get better. But before that, I think we need something potentially big to happen, and don't be too early. We really feel like the equity market could go lower based on what is happening on other asset classes. There is a lot of unwinding, panicking for other asset classes. All the best to you, and talk to you next week. Bye-bye.